Welcome to the Unseen Currents, a deep dive into the intricate world of Australian finance, where the ebb and flow of cash can define the very survival of enterprise. Tonight, we pull back the curtain on the silent battles faced by small business owners and freelancers across our sunburnt country. From the bustling cafes of Melbourne to the remote workshops of the outback, managing cash flow isn't just a spreadsheet exercise, it's the heartbeat of a dream. Our focus, the payroll, the superannuation, the tax obligations, and the unpredictable currents that challenge even the most meticulous planning. We're joined by our expert panel, Ben, our technical analyst, Chloe, our consumer representative with real-world insights, and Diana, our institutional insider. Ben, let's set the scene. What are the macro conditions currently shaping the financial landscape for Australian small businesses and independent contractors?
Adam, we're observing a complex environment. On one hand, consumer spending has shown periods of resilience, particularly in certain sectors. However, underlying this are sustained inflationary pressures impacting input costs and, consequently, operational expenditure for many smaller entities. This creates a tighter margin environment demanding heightened scrutiny of every dollar in and out.
Chloe, from your perspective on the ground, how does this translate into tangible challenges for a typical small business owner or a freelancer managing their income?
It's a DLE juggle, Adam. Take Sarah, who runs a small graphic design studio in Perth. She recently had a major client unexpectedly delay payment for a large project, shifting her anticipated cash inflow by 45 days. This wasn't just an inconvenience. It meant she had to cover her two junior designers' award rate wages, let's say a combined $3,200 per week, for an additional month out of her reserves. On top of that, she still had her quarterly business activity statement, or BAS, coming due. If her projected GST payable was around $7,000 and her PAYG tax installments another $4,000, that's $11,000 and she needs liquid, quickly. This single delayed payment created a sudden deficit of approximately $12,800 in wages, plus $11,000 in tax obligations, totaling nearly $24,000 from her emergency fund, all due to an unforeseen payment delay. It's a common story. Excellent work done, but the payment terms, or lack thereof, can create an immediate cash flow starn.
Chloe's example perfectly illustrates the inherent volatility. From an institutional viewpoint, we benchmark operational stability. We've seen situations mirroring the news report about the piggery owners in court, accused of fling to ensure adequate and appropriate living conditions for their animals. For a business, fling to MNTN adequate conditions for its financial health by neglecting cash flow, for instance, can lead to severe repercussions, whether it's legal challenges, reputational damage, or an inability to meet basic obligations. It underscores that fundamental operational hygiene, financial hygiene in this case, is non-negotiable. Neglecting these basics, even unintentionally, can rapidly erode confidence and stability.
That's a powerful parallel, Diana. The headlines about security staff intervening during a bottle shop robbery in Hobart also resonate with the unexpected risks businesses face. Chloe, how do unforeseen disruptions, like a security incident or even a supply CHN hiccup, translate to direct cash flow impacts for an SBO or freelancer?
Absolutely. Let's consider Mark, an independent electrician running his own small business in regional Victoria. He sources specialized components from an overseas supplier, typically costing him around $500 per unit, and he needs about 10 units a month for his regular jobs. A global logistics issue might suddenly increase shipping costs by 30% and add 2 weeks to delivery, effectively arsing his unit cost to $650 and delaying his ability to complete jobs and invoice. That's an extra $1,500 outlay he hadn't budgeted for, plus potentially 2 weeks of delayed invoicing for jobs that might total $15,000. Furthermore, if he has an apprentice on an award rate of, say, $850 a week, he's still paying that apprentice during those delayed periods, even if work slows down due to component shortages. These bottle shop robbery moments, those sudden, unexpected operational risks, directly eat into his liquidity and profit margins, forcing him to dip into future earnings or credit.
Moving deeper, Ben, beyond the immediate challenges, What are the underlying structural drivers in the Australian economy that are creating this environment of heightened cash flow scrutiny for smaller players?
A significant driver, Adam, is the sustained pressure on wage growth within certain sectors, coupled with rising input costs across the board. Businesses are navigating higher energy prices, increased raw material costs, and often a competitive labor market. These factors compress gross margins, meaning less buffer cash is naturally generated from sales. Historically, periods of strong economic expansion often masked these pressures, but in a more modulated growth environment, every basis point of cost increase becomes critical.
This hits home for individuals and small businesses directly. Think about David, a freelance web developer based in Brisbane. For years, his hourly rate has been relatively stable at $90 per hour. However, his cost of living has risen. Rent, groceries, petrol, everything is incrementally more expensive. He needs to cover his own superannuation contributions. If he MES for the current employer super guarantee rate of 11% on an equivalent full-time income of $70,000, that's $7,700 annually, or about $640 a month he has to set aside from his invoiced earnings. If he also estimates his income tax liability at, say, 25% of his gross earnings after business expenses, he needs to squirrel away another $1,450 each month. So, out of that $90 an hour, he effectively needs to factor in roughly $25 per hour just for super and tax prepayments before he even considers his operating costs, like software subscriptions, professional development, and personal living expenses. This isn't theoretical. It's tangible money that must be held in reserve, not spent. If clients are slow to pay or projects get delayed, that $2,090 monthly allocation for super and tax quickly becomes a gaping hole in his immediate cash flow. This makes understanding award rates and industry benchmarks crucial, even for solo operators.
Chloe highlights a critical structural point. Larger enterprises often have dedicated treasury functions and robust credit lines to absorb these shocks. They can leverage economies of scale in procurement or access capital markets to manage working capital more efficiently. Small businesses and freelancers, however, operate with inherently less financial cushioning. Their resilience is often tied to personal savings or short-term credit facilities, which can be more sensitive to a general credit tightening or market correction. We also see this in the context of the recent report about the NSW DPP inquiry, which focused on media leaks rather than its core purpose. Distractions and reputational issues, whether internal or external, divert resources and attention, often leading to unforeseen financial outlays or missed opportunities for revenue generation. For an SBO, a single adverse client review or a public dispute can have a disproportionately higher impact on cash flow than for a large corporation.
This leads us to a fascinating divergence. How do institutional approaches to capital and risk management contrast with the DLI realities for our SBOs and freelancers, Ben?
Fundamentally, institutions typically engage with diversified asset classes, each reacting differently to economic cycles. During periods of economic moderation, for example, certain fixed-income assets might offer relative stability, while equities could experience greater volatility. This diversification strategy aims to mitigate systemic imbalances. For an SBO, their primary asset is often their business itself, and their immediate cash flow is directly tied to its operational success.
Exactly. Consider a major superannuation fund. They can invest in a basket of Australian equities, bonds, infrastructure projects. If one asset class experiences a slight downturn, others might provide a counterbalance, smoothing out returns and preserving capital. Now, think of Anna, a freelance photographer in Sydney. Her portfolio is essentially her active client base and her personal savings. She needs to set aside for her own personal super and, crucially, for her provisional tax. If her average monthly income is $5,000 and she needs to provision 11% for super and 20% for income tax, she must squirrel away $1,550 monthly. This money often sits in a standard savings account, earning minimal interest, just waiting for the ATO or her super fund to CLM it. She cannot afford a delay from a major client. A $3,000 wedding shoot payment delayed by a month means her planned $1,550 tax and super allocation might be short, forcing her to choose between personal expenses or future financial security. There's no diversified bond portfolio to fall back on for immediate liquidity. It's just her camera, and her bank balance. The tax hack for her isn't some elaborate scheme, but simply ensuring she correctly estimates her income and expenses and consistently puts away a percentage of every payment she receives.
Chloe perfectly encapsulates the liquidity challenge. Institutions manage massive cash reserves, employing sophisticated treasury management systems. They might use cash pooling, short-term money market investments, or even currency hedges to optimize their working capital. This allows them to maintain high levels of operational flexibility even during periods of market correction or systemic imbalance. For small businesses, the equivalent treasury function often falls on the owner's shoulders, demanding acute awareness of every invoice, every bill, and every statutory obligation. The margin for error is significantly narrower. Benchmarking for them involves understanding payment terms within their industry, for example, how quickly average clients pay in their sector, and actively managing those expectations.
As we look ahead, Ben, what macro projections or trends do you see impacting Australian cash flow dynamics for small businesses and freelancers in the coming periods?
Adam, we anticipate a continued emphasis on efficiency. Economic data suggests a modulated growth trajectory, meaning businesses will likely need to maintain a sharp focus on cost management and revenue diversification. Consumer sentiment, while volatile at times, remains a key indicator. Sustained consumer engagement, particularly in service-based industries, will be crucial for maintaining revenue streams for many independent operators. The broader investment landscape will likely continue to differentiate between sectors with strong underlying fundamentals and those more exposed to rapid expansion or sharp decline.
This translates into very practical considerations for people like Michael, who runs a small catering business in rural Queensland. He needs to project his income not just monthly, but often seasonally, for events like harvest festivals or local FRS. To manage his cash flow effectively, he might implement a 3-bucket system, one for immediate operational costs, one for statutory obligations, and one for future reinvestment or emergencies. Let's say his average monthly revenue is $12,000. He might allocate 50% to operations, 25% to his tax and super bucket, and 25% to his growth on true emergency bucket. This kind of systematic, almost automatic allocation is a critical tax hack for cash flow. It ensures funds are reserved before they're accidentally spent. For his employees, ensuring he correctly applies award rates, like the Hospitality Industry Award, isn't just a legal requirement. It's a fundamental part of his operational cost planning. A miscalculation, even a small one per employee, compounded over weeks, can quickly erode his profit margins and create a cash flow deficit. It's a continuous, proactive process, not a reactive one, especially when payment terms from larger corporate clients might extend to 60 or even 90 days.
Chloe's insight on proactive management is spot on. For institutions, forward planning involves scenario analysis and stress testing. They model the impact of various economic downturns or systemic imbalances on their portfolios and operations. For SBOs and freelancers, the equivalent is building strong reserves, negotiating favorable payment terms, and meticulously tracking receivables. The ability to adapt quickly to changing market conditions and maintain stringent financial discipline will be paramount. The key takeaway, whether you're managing a multi-billion-dollar fund or a sole proprietorship, is that robust cash flow management is the bedrock of enduring financial health, offering resilience against unexpected turbulence and allowing for strategic growth.
A truly illuminating discussion, from the subtle shifts in macroeconomic indicators to the very real impact on DLI operations. The financial landscape for Australia's small business owners and freelancers is one that demands vigilance and adaptability. Thank you, Ben, Chloe, and Diana, for shedding light on these critical, unseen currents. We hope this deep dive provides valuable context for navigating your own financial journeys. Good night.